And to the first question, how I got into crypto, I would say I got first into blockchain. Blockchain as a kind of technology. So I started my career in Prague, Czech Republic, in EY 6 years ago, and I've been in digital financial services practice. So I've been leading the innovation group there and really trying to ideate, design, and deliver some digital products for banks. I have delivered uh, 3 solutions in 2 countries to large banks. And around 2017, the ICO craze happened. And because we were like the innovation group, we were like, oh, what's the new technology here, what everyone is trying to sell, and how we can kind of incorporate the technology into our products and make the products even more innovative. So I started, let's say, around 2017, really learning more about it and also educated others how we can incorporate it into our products. And from there, I got into a global role within EY, which is the product and program management in EY blockchain. And now I'm in New York working for our EY blockchain group. So that's how I get here. And you know that there is maybe more to it, but if everyone is okay, I can start with short introduction, kind of how I see the market going now, and then get into more of like what needs to happen next and how EY is contributing. Is that okay? Okay,
Yeah.
seems okay. So let me share my screen. Okay. Can you see this presentation?
Yes.
Yeah.
Perfect. Okay, so yeah, so the today it's called the future of business enabled by blockchain. So let's go right into it. The
Pardon,
first
Jan?
yes, is Michael?
Thank you. Maybe you might want to switch the swap displays button.
Yes, that's correct. Do you see now the presentation?
Yes, thank you very much.
Yeah, you would get too much ahead if you see all the slides.
Mhm.
So thank you, Michael. So first is like this time is different. I told you I got into blockchain 2017. It was like big craze, everyone was raising money on like very wild ideas. And honestly, like not many of those ideas actually happen to be very valuable, and there are many people rather lost their money and those companies disappears. So that part was boom. However, it was not really delivered on the promise. Also, if we look at the next slide, that boom was pretty small, pretty tiny compared to this year. If you see on the graph, like the 2017, you see how it went up. It went very sharply up. Bitcoin went up, Ethereum went up, everything went up. However, 2021 much higher. So this year, much more people got involved. Many more people got involved. Many more companies and institutions got involved. And the big difference this time compared to last time is we are seeing real companies building up their product and really delivering the value. It's not anymore a speculation. This is already really delivering services. Uh, and we at EY actually also had like our first kind of strategy set up 2017, and we did it right. We actually, really pursue that few ideas, and now after 5 years, 4 or 5 years, we see that it's really getting where we thought it will get. And the first thing is we really bet on public blockchain. There was many trials how to do private blockchains. Every single company done their private blockchain, but like the purpose of decentralization is to have public space where you can share the infrastructure and interact between each other, not to create another silos within your silos. So actually, like, this has been like what companies were trying to do, but it did not really work out. The public is the future. Now we can see that only public networks actually stayed. Notarization and to tokenization. What we saw 2017 was a lot of notarization types of the projects. Means, okay, we put this paper on blockchain so you can see that it's valid. That's nice use case. However, it's not going too far. We want those assets to be able to transact with them, swap them, increase in value, something like really using them in the smart contract, in the business contracts. Therefore, we needed tokens, and tokens are the one which now actually almost every single project is using for their products. The third, I would say, this is, and I would maybe get to it later, like, crypto is important. It was like it brought a lot of people in. However, we need some stability as well for those kind of protocols and executions and so on. And we cannot buy one day, I don't know, bunch of paper for 0.005 Bitcoin, and then the Bitcoin price next day will be doubled, and we pay double for the paper. We want some stability for it. Therefore, now we see a lot of use cases with the USDC or other stable coins, and that really makes sense for the business processes. And we also back then said that probably will be the future. We see the crypto now, but we need some stability there as well. And like, basically, to kind of close it out, like, if we have the public network and we don't have many private networks, that actually integrating all the ideas, solutions, and products into one common innovation space. And that's super important. We need to work together towards the common innovation. And we can see it on the market now. I don't know if you maybe already part of some, protocol DAO, or like you are, trading, but you can see on Discord, you can see on other communication channels, those protocols really working together to make something happen. There is competition for sure, but they are on the same platform. They want to same improvements. They want to be secure. They have similar goals, and this is really important to build the new ecosystem. I hope it's fun. And I already maybe touch upon this, but I think the biggest innovation nowadays is happening in DeFi. Like, DeFi this year, there is the biggest number of companies, biggest numbers of product, what actually just arise, and also in terms of value. Like, the innovation there in terms of locked value, it's tremendous. Like, that's really something what skyrocketed, and we can see that it start really working towards something what is useful for us as, let's say, regular users to use. Because I don't know how anyone has a saving account. Yeah, so
Yes.
like, the I don't know, it's like 0.000 0.00 nothing, what you are getting on your money. And now you have, DeFi, where you can have like yield farming or staking, and you earn like 3, 5, 6%. And there are still risks involved. So I do not recommend put all your money there. I am always saying use only money which you can lose, because if you start using DeFi, you probably lose all your money at the beginning, just to learn how it works actually. So this is not investment advice, nothing like that, but it's like nice product, and we can see the difference. We can see how if you make stuff more efficient, you can actually give more to the user. And this is really what it's happening now. And maybe one more question what I want to ask here. Do you know any of those protocols from DeFi, or are you familiar or even working in? Is it anyone working in some of the DeFi protocol, maybe as a, internship? No? But are you
No.
familiar with any?
No, actually, my question was going to be, what is DeFi?
Oh, perfect. No, that's a great question. So DeFi, it's a decentralized finance. So basically what you can see now at the regular financial services, banks, brokers, etc., works on mainly Ethereum, but let's say on blockchain as a protocol or smart contract. So it's kind of programmed to work based on some instructions. So now if you want to trade with a broker, you go to broker, you put the money there, you initiate, you want to buy something, the broker execute the transaction gets settled in 2 days, etc., etc., etc. So there is like many middlemen in the between till you actually own the stock. On DeFi, this is much more like there is a smart contract which is just buying, let's say, that particular token. And whenever I want to buy, I just put the guidance, please buy.
I gave it to Trevor.
For the laptop?
Yeah.
But what about
Yeah.
can
you
everyone mute?
Main computer.
Oh, you don't have it, you just connect your laptop?
Yeah.
Oh, okay,
Yeah.
got you.
Okay.
Okay, so we have some laptop. Good. So and the smart contract works like that. I want to buy, let's say, 5 Ether. So I just give the instruction, and the Ether automatically get kind of the cell get executed, and I receive the Ether for my USDC, for example. That's how Uniswap works, which is the automatic market maker. So I'm just swapping the tokens, swapping my money for some tokens. There is other products on the decentralized finance market, like lending, where I use my assets as a collateral to get some money as a loan. So I own a lot of Bitcoin. It's just sitting in my wallet. I have nothing to do, but I need to buy some birthday gift. So I need some cash. So I put my Bitcoin into that other wallet as a collateral, and I take the value of that collateral, or slightly less, because there is some risk management into it. I took like USDC from it to buy something for it as a gift, and then I repay the loan, the USDC, and then I get my Bitcoin back. So there is like different types of products, but it's basically the ecosystem of the financial services, which are not, let's say, owned and executed by companies, but by protocols and smart contracts. Does it make sense?
Yes.
And thank you for the question. I just assume that you know something, but this is really important to have that information, that basic understanding. So please stop me if I will get too far or something. Okay, so that was the DeFi, and those products, and you can see it on the next slide. These are just the building blocks. We are just at the beginning. Like, they are not very complex products. They are very, very simple products now in DeFi, like lending just collateral and money, just that. There is no like uncollateralized loans that you just are scored as a client and get the money for that, or like mortgage or something. There is no more complex transactions. It's very simple use cases. So we really now building the digital innovation blocks. And as you can see in the like other like aspects, not blockchains, but where else the innovation happens, that's just the beginning. And then we will get to, you know, more sophisticated products, like something what we want to improve based on user feedback. And then on the combination of those, we might find totally new market where users' needs are not satisfied, and create product which now we don't know even that it's possible, exist, or like why we even want it, you know? So if you asking like where we are at the kind of innovation curve, we are at the beginning. Like we have not even started properly. We are just building the blocks. So the celebrity chef branded restaurants are coming. Seems that some reactions. Uh, and that's like how we see the market now. But the decentralized finance, it's not the only thing what is happening now. This is really coming informations. Decentralized finance came first because it's already digital. Money are already kind of digital. You don't need to take real world asset. You don't need to change much processes. You can just start innovate because it's already out there. We are using money in Venmo and everywhere else in digital form. But to move slightly, you know, to the next steps, then there will be something like the real world examples, how we can use blockchain to execute the transactions. And that can be, for example, procurement. EY has its own solution, upstream procurement, where we basically take the smart contracts, the same what we use for the centralized finance, to execute some transactions, but the transaction will be connected to real business use case and real business assets. So if I want to procure stuff, I have money, you have stuff, we can execute it automatically through that smart contract. But it's then much more complicated because we need to connect the real world assets to it. And it can be the same with the other use cases. And then, you know, if we have this like business use cases, what we connect to the real world assets, then we literally start changing the business operation and how it works. Now we are just digitizing, but the next steps after it will be how we can change the process so we can improve those efficiencies and everything. So what needs to happen to basically decentralize everything, or really like mature the decentralization, the blockchain market? First, regulation. We need some regulation to have on the market to kind of legitimize it and get mass adoption. Protocol economy, that's what I called incentives. Nobody will join the market without the incentives. Why everyone is joining crypto? Because we want to become millionaires tomorrow, or billionaires, better. Yeah, so there needs to be incentives. There needs to be incentive why to join. Doesn't need to be being a billionaire, but it needs to be at least to you know, get more than I used to get through the traditional process. And third, cross-chain integration. As I said, like the next use case is really to connect the real business use cases and real world assets to the chain and really operate as not only digital stuff, not only moving money, but start moving also the assets. So that's the kind of three aspects, and we can go deeper into it. So regulation. there are different opinions, like how much to regulate and if, and so on and so forth. So my personal view on this is we need some regulation, but we should not be over-regulated to slow down the innovation. But we need regulation to give a guidance, legitimize the market, and make safe the market to enter and to be on. Because if this is like not really regulated, is it legal or illegal? Like we are in between kind of, and institutions don't want to join this kind of markets. Majority of people don't want to join this kind of market because uncertainty and so on. So we need some guidance here. We need some legitimation of it, but we don't want over-regulation to slow down the innovation. The next, incentives. And basic, as Jeff Bezos famously said, like your margin is my opportunity. And this is what we are doing here. Like there are inefficiencies, there are possible improvements to the products. Let's do it. Let's be better than you know, these old industries or how they do it, pen and paper. Let's digitize it. Let's be more efficient. Let's earn some margin on it. And there are three aspects what we are working on. I already mentioned incentives several times. I will mention again because I think it's important. We need to have incentives. If I'm joining crypto, I need to have incentives to be there. I need to have incentives to either work there or put my assets there to work. Means that I earn some interest and so on. Governance models. Currently, we have like let me put it that way. The decentralization, it's great concept. And I like that like we are empowering people. However, not every token holder is interested in that particular protocol or project. I would say like 40–50% of token holders just hold it because someone told them it will go up, and they don't know even what it's about. Maybe another 30%, it's like, okay, I know what it's about. I don't want to really contribute. I don't have time for it, or I'm not even like qualified to contribute. And then we have maybe 20, which are like, know something, don't have time, so on. And then we have like 5%, those token holders, which actually are super interested in it, knowledgeable, they want to be involved, they want to provide some work, some contribution, they want to improve the protocol, and so on. If we get everyone vote for some idea, it's not great because 95% doesn't even know what we are voting about and are not incentivized to vote because currently we even pay for voting by the gas cost. So that's not great. So what we are working, or many protocols working on, is how we can make sure that that 5% get the delegated kind of power to really start improving the protocol for the benefit of all the stakeholders. So we decentralize it. However, now we need to streamline it a little to work as a company and really push the innovation forward and not slowing it down. The last one is operation design. So that's basically how we will now take those decentralized finance use cases and really put it into work, into real world use cases. So I mentioned supply chain several times. That how Amazon is shipping goods to you, it's not yet designed to be on the blockchain. It's not designed that you can pay on blockchain, that you can see your order on blockchain, and that there will be some benefit added to it. We need to see those processes redesigned to actually get the benefit out of those innovations from crypto and blockchain. And the last one is the interoperability. It's really about how we can integrate the real-world assets. So you won't be buying just a Dogecoins, but you will be actually, buying a real-world, like, no, I don't have an example. Anyone has some example what can be worth buying?
It sounds like you're saying it's going to be an asset-backed security, like something tangible will be behind it.
Yes, exactly. So basically now I can buy only Dogecoin, but I want to maybe buy a car, and I want the car to be kind of financed and backed by my Bitcoin, which I can kind of put against it and buy the car. So I know that Tesla offered that you can buy Tesla with Bitcoin, but by that you are actually losing Bitcoin. You will be sending Bitcoin to them. But maybe the next use case is I have my Bitcoin, I put it as a kind of collateral back, then I take Tesla car and I will just be repaying the loan. So those kind of use cases just needs to start happening, because just buying crypto just to hold it, it's like not really bringing that much value. We need to bring the real products and real use cases, what we will actually be using to it. And that's connected to all the other aspects, like how we dispute resolution. Now it's all the loans, all the products are basically that if you do something wrong, you lose your Bitcoin, you lose your access, and so on. But if you will be buying car, they might want to take the car if you don't pay. So there needs to be some real world resolution possible, so they can basically take your car and sell it, and then you pay the difference. So something like that needs to happen to really support the market. I see Priam raised hand, so
Hi, Jan. Thank you so much
hey.
for thank you so much for your presentation. I just had a question about something you said just a few moments ago. You were talking about how Amazon, like the supply chain network that they have from shipping and delivery and payment processing, it's not on any kind of blockchain network right now, and that they would have to ultimately adapt if they were to implement blockchain. Assuming that other companies like follow suit, which I think they probably will, then do you think that each company will kind of create its own blockchain network, and that the system going forward will just be like really fragmented? Or do you picture like a bunch of the biggest companies in the world getting together and saying, let's decide to use one blockchain network going forward?
No, that's a great question. And or a few years ago, there has been like blockchain for every company. So every company created their own blockchain, their own private network, and they tried to operate on it. But it didn't work out, because then they could not really leverage that kind of cooperation, that centralization, and how they can operate together. So if I am Amazon, I need to use logistic provider. So should I have my own blockchain and the logistic provider like UPS their own blockchain, and how we actually can send the tokens of the goods from one blockchain to another? So to your question is, we need to operate on one network, maybe couple, that will be really per use case. So there will be something like for logistic goods and supply chain, and maybe that will be all on Ethereum. But there might be some other chain which will be really fit for some specific use case, and like group of companies might like join that, and then we will have some bridge between it. So there might be a little bit more complex system than one serve all, but I think one, like now we see Ethereum as the like greatest adoption, probably will have the most companies on it and most use cases as well.
Okay, yeah, thank you.
No, thank you. That was a really good question. I saw one more hand there, or maybe not. Malcolm.
Hello, can you hear me?
Yes, I can hear.
So my question is, what are your thoughts on global stablecoins as central banks consider developing digital currencies? Will global stablecoins be considered a competitor to fiat and even considered a threat to sovereignty? End question.
Okay, thank you. So first, I think there is place for stablecoins. And how you make it stable, it will differ. So I know that we are using now mostly, US dollar-backed stablecoins. China is planning their own stablecoin and so on. But there is many projects which are now working on being backed by something else, like ETFs or carbon credits, different type of kind of assets which will be backing those coins, how to make it stable. And what my vision is in this is like, and it's really related also to how we will be using crypto and stablecoins in the future. I think every person in the world, and this is not really near future, it's it's more like future, will be having their currency by choice. Means I like dollar, I might use dollar as my currency, and everything what I ever buy, interact with, will be denominated by dollar, because I will have it in my kind of wallet setup or profile setup that I want everything denominated in dollar. But someone might want like carbon credit backed coin, and everything what they will be buying, and interacting with will be uh, denominated in that currency, and they will not interact with other. I think because as a person, it's hard to remember the conversion rate, and then like, okay, if it's like half of ether, how many dollars is that, and so on. I think every person will have their currency of choice. It might be a community thing, it might be uh, different preferences. So that's basically to your question. If there will be any global stablecoin, I think yes, and it will be backed by something what is kind of with global scales, not tied to one um, central bank. Uh, and the other question, if it's influencing the like state sovereignty, currency, it's or like the system what we have now, it's very powerful in terms like that they can control the economy, they can control the inflation, and like there are incentives they are sending to the market. uh Moving forward, I think it will not be like very fast change. I think that we will see a lot of resistance from the central banks. However, we can see that, for example, and I'm from European Union, so I saw it firsthand. They had their own currencies. Now all of them, but Czech Republic, is using euro, and they basically like give up on their monetary policy. They just adopted euro, and everyone is kind of fine. There was like few years that everyone was kind of calculating in their own currency and then paying in euro, but now nobody even remembers that. So I think it will be similar process. For some time we will have like dollar and that global currency, and then someone just decide to use the global currency for everything, and eventually just like kind of switch to it. And does it answer your question?
Yeah, that does answer my question. The interesting thing is, like, I think the approach that naturally that global stablecoins could resonate with people, but my question is, will the regulators really allow it if they see global stablecoins as a potential threat to their currency sovereignty? Because currencies are a form of leverage, and if you see how the G7 reacted to Facebook Libra a few months ago, then you see that it is actually a legitimate concern for them.
That's a good point. So I think there will be resistance 100% from all the central banks that they don't want to give up on their tooling kind of, and how they can control the market. What I think it's important, and why I think Facebook got even more resistance is it's a private company. They tried to do it as an open source, but there was a concern that it will be a monopoly and that they will be having even more control over our lives than they have now. And I think this needs to happen as kind of open source decentralized project, means that it will be kind of owned by nobody. It will be just programmed to work. There will be contributors to it, but there is no such a like CEO who can decide, or like group of stakeholders who can decide about the future of it. It needs to be just out there, maybe have some control mechanism to it, connected to some government agencies, but really it needs to be rather open source and decentralized. Otherwise, I don't think that they allow any private company to do something like global stablecoin.
These are all great questions so far. Everyone feel free to just keep raising your hand if you have a question. And in the meantime, I'm going to go to some of these questions that were submitted in a pre-event survey we sent out. So one of the questions we have here is, do you think a fluctuating and normally not in whole numbers currency can negatively affect implementation of crypto in the world of transactional finance?
That's a good question, and I think it's very much connected to what I said previously. I think there will be eventually currency of a choice. So, you know, I can choose dollar to pay in dollar. Someone else can choose Bitcoin if they want to pay only in Bitcoin. And everything will be denominated in that kind of currency. So even though that's not whole numbers and, you know, it's sometimes awkward numbers, maybe like that is 0.0000 something, I think people will just have their own currency, what they are used to it, and for them will be actually like comfortable to pay in those. I don't think they will pay in crypto per se. I think it will be more like stable type of currencies, but that's how I think it will really work. I hope I answer. Yes. Did I answer it?
That was great. That was awesome. And this pertains to in-person transactions, but what are specific ways crypto can be used in those types of transactions or in the future?
Yeah. So in like specifically in like in-person transactions, there are now many projects which are working on kind of accepting Bitcoin or Ether like at the, you know, grocery store or like a farmer market or something else. From user perspective, it should not feel different. It should be really like, I just want to spend my Bitcoin because I have it, my Bitcoin on my account. I just put my credit card down and it will just take, instead of, you know, dollars, it will take Bitcoin, or, you know, I can pay with QR code or something like that. But I don't think that for now there will be any user experience difference in those type of payments.
Awesome. And we also have a question from Damien. Damien, would you like to unmute yourself and ask your question or put video on? If not, I can ask it.
Okay, I can read it. So Damien, just tell me if I answer your question. So I think this is a great question, and I believe Visa actually published recently some kind of research on this and how they think how it works, and I mean that's kind of aligned with my thinking. So I basically took their ideas and just telling you. So it's, if you pay in one currency and the merchant like has different preferred currency, it will just convert. As I said, like there are smart contracts which can like automatically convert, you know, some assets to different assets, and that's how it will work. You won't even see that I prefer Bitcoin and paying with you. You will just see that because you prefer dollars, you just receive dollars from me. And it will be very seamless seamless transaction because it will be everything very automatic. And like the accounting process, in that sense, the merchant will basically only account for their dollars. So the accounting should be simple, and they should be accepting only one currency. Damon, does it answer your question? Okay, perfect.
Question in terms of the merchant from that. So when they accept it, does it follow a LIFO or a FIFO when they recognize the gains in terms of for tax purposes? So say Bitcoin is worth $40,000 when they get it, but then they cash it out when it is 60,000. How, in terms of accounting principles, is that going to be recognized or built in terms of capital gains?
I'm in accounting company. I'm not an accountant. So so I'm sorry, I cannot really answer that question, but from just what I can answer is from merchant perspective, if they prefer dollar, they will just accept dollar, and they won't accept anything else. If they accept Bitcoin, they will all the time accept Bitcoin. And then how they account for it, that question needs to be answered by my colleagues from the accounting team.
Awesome.
But I can follow up on that. If you send me an email, I will share my email here, and if you send me my email, I can follow up on that.
All right, great, thanks.
Awesome. We have a question from Joshua. If you'd like to go ahead and unmute yourself.
Perfect. Thank you so much. And thank you for the great presentation. Really learned a lot here. So I had a two-part question. The first part of the question is, I was doing some research and I see that EY has done some work with Polygon, which is a protocol that I've personally invested in. So it's good to see. So my first question is, are you able to speak about the Nightfall project, if your team worked on it?
Yeah, so it's basically just got announced. So I don't have more information that it's kind of publicly available, but I think it's just great how, really Polygon step up into kind of layer 2 solutions, and they are really trying to develop something great there. We are very much aligned as EY and Polygon on the strategy that the privacy is very important. It means that if we want to have business transactions on the blockchain, we cannot have everything publicly available. Like I don't want, for example, you to know for how much I sell, my goods to Michael, because I might give you different type of discount or a different type of a deal. So these kind of transactions needs to be really private, and that's basically what Polygon is trying to work on, and we as a EY have been working on that similar stuff that's called Nightfall zero knowledge proof protocol since 2018. So we have some experience there, and that's basically the what now we are in discussion or teaming on.
That's great to hear. And my second question actually leads into that. So could you explain what zero knowledge cryptography is, and does it differ from proof of work and proof of stake?
Yes. So I cannot go deeply into the math, but basically the zero knowledge proof technology is basically proving the other parties that I have done something what they wanted me to do. So for example, if I have send the shipment with all the goods, I can send the proof to you on chain. Then off chain, I can send you kind of the verification mechanism. So on your side, you can verify that I have sent the shipment, but without me disclosing you all the details about it, and without me to actually put in those information on chain. So those information can be verified but cannot be exploited. And there is really math behind it, how the curves works and how basically like through the cryptography you can prove it, but you can not really, reveal the information behind it. So it's like kind of one-way cryptography. Regarding proof of work of proof of stake, it's basically proving the transactions that it happened. So that basically you have the validators in proof of work, which are trying to calculate some, I would say, mathematical problem. And then when they get it right, they have the right to execute the transactions. They put all the transactions into the block and execute it. And then the network can verify it that happened. But there, it's private. It's all publicly available. They just got the right to kind of execute the next block. Does it make sense?
Yeah, I got it. Thank you.
Yeah, so both it's cryptography, so it has the common denominator, but it's just like different purpose.
Thank you so much for that explanation.
All right, we have another question here in the chat. Michael, if you'd like to unmute yourself to ask the question.
Thanks, Elizabeth. Jan, thank you so much for this presentation. Listening to you talk about topics in blockchain and DeFi, it's so exciting because it's like something that's like right around the corner and you know it's about to be here, but like you can't see it or touch it yet. So this is really great to be a part of. So I want to ask you a little bit about fintech and systemic risks. So one of the hottest firms in fintech right now is Plaid. And Plaid is a company that develops APIs that allow different financial platforms to communicate with each other and share data and information. Do you think the expansion of solutions like Plaid are related to the distributed ledger? And do you have any, like off the bat guesses about what might be some systemic risks in a financial system that's increasingly interconnected, but decreasingly centralized?
That's a good question. Yeah, let me think about it. The interoperability, it's important, and that's why I said at the beginning, like we should be working out of one chain, preferably, because then we don't need to really solve the kind of interoperability challenges between different systems and different infrastructure. But there are still, everyone needs to get the connection to Ethereum. So there is still kind of places where companies can help the other enterprises really like connect to the network, and also to create those smart contracts which will manage that interaction. So I would say the technology is different. So you are not connecting really through like APIs, just point to point to exchange information, but you are building those connectors with some business logic on it. So in APIs, you have it kind of predefined, like, okay, if I send you this, you send me that information, and it's kind of simple. It cannot be really complicated business logic in it. At the blockchain level, you have those smart contracts which can be long as you want, and you can really execute a business transactions on it. So one company send information that triggers to request maybe some goods from other company. When that's shipped, it gets confirmed on the blockchain, so the invoice gets sent and the payment goes through. So it's much more complicated than just like simple interaction, because it's basically owning the business logic. Systemic risks, or what are the biggest risk in this kind of system, is you are revealing a lot of stuff. Like currently, the like technology nowadays, like we are trying to like hide it so nobody can kind of attack it. So if they don't see, they cannot attack. Now we basically open everything. Everyone sees the code, everyone sees what you are doing there, and that's really open to exploits. And there are even some tools to like be more efficient in exploits, like flash loans. And I don't want to get into details, but you can basically borrow quickly money to do some quick exploits and then return the money in the same transactions, and kind of which you use for hacking or something like that. So, but I don't think it's bad or like overall, because we are improving by that. Once some protocol get exploited, it gets patched immediately, community get into it, and they really cooperate to kind of fix that problem, because other protocols can face the same. So there is much more risks involved in this, because it's decentralized, it's open, you can see everything. Basically everyone can kind of try to attack, see the vulnerabilities, and so on. What I see the biggest advantage here is, because it's so open, also everyone, or not everyone, but the community really reacts fast, not just within one protocol or one company, but when exploits happen, everyone gets there. Senior developers and everything are immediately giving kind of advices, how we can solve it quickly, or how to shut it down, how to find some workaround. So this is really great, and that's why I think this has a future, because we really cooperate kind of as a team, even though we don't know each other. So does it answer your question?
Yeah, so your answer to the first one was, don't mistake those two things for being more similar than they are, because the one is just point to point and the other one is the entire system sort of like being facilitated through like smart contracts and things like that, whereas the APIs just pass data back and forth. And for the second question, you're saying it's a lot of the same sort of systemic risks that people have been worried about, but the technology and the industry and the regulations are catching up on those risks quickly.
Yes. So yeah, to your first, yeah, I think that's right. It's just like it's much more broader than it used to be, and you can like operate more. And yeah, and the second, that's correct. Yeah, I think we are having more risks now, and more open risks and revealed risks, but I think we are now also fixing it much faster. So that's
super interesting. Thank you very much.
no problem. Thank you for a question. I see we have last 2 minutes.
Yes, these have been amazing questions. And, thank you so much, Jan, for coming on here to, speak to us about blockchain and, just your subject matter expertise. It's been amazing.